I mean, we're getting to maximum inflationism in the EU. We've also got it everywhere else because the Bank of International Settlements, realizing that there's not a lot that central banks can do, they can't lower interest rates anymore. Well, that doesn't work. Nothing works. The system is falling over. Government's just got to spend to try and keep the show on the road. And that is almost official from the Bank of International Settlements. So there is a huge, huge crash to come when people actually realize that government bonds are wildly overvalued. And in the case of the United States, there is a further problem, and that is that dollars are owned by foreigners and also hedge funds, because the hedge funds have been playing the swap market. Now we're at the situation where they're all up to their necks in dollars, everybody. And there's only one thing that can happen as soon as people realize that the whole market is horrendously mispriced, and that is that the dollar has got to be sold down. So what this does is it ties in the value of the principal financial asset in the market, which is government bonds, to the currencies. One falls, they both fall. When you see a government getting onto the inflation bandwagon and they've got no alternative but to print, and they print at an accelerating rate, we see a Venezuela. We go back a little bit, we see Germany in 1920 to 23. Basically, we think it takes a few years for this process to work through on the currency. But if we follow the John Law model, and it looks like we are, then it's a process that can happen a lot more quickly. And if it happens to the dollar, and therefore the rest of us, we could be looking at a radically different world by the end of this year, with equities, bonds effectively worthless, fiat currencies effectively worthless.
As a responsible person with growing concerns for your privacy and personal liberty, you want to know where we're headed and what you can do about it. We ask the experts what you need to do to take prudent and responsible action to safeguard your family's wealth and well-being, and what basic first steps will help you to be aware and prepared. ReluctantPreppers.com.
Welcome back to Finance and Liberty and Reluctant Preppers. We're delighted to have this distinguished returning guest. Alasdair Macleod is the head of research at goldmoney.com. He joins us this Wednesday, February 19th, 2020. Alasdair, thanks for being here.
That's my pleasure, DK.
Hey, before we get to lots of viewers' questions that have been submitted ahead of your appearance here, we wanted to check in with you on the actual survival of the civilized world beyond the Britain's exit from the EU, the Brexit that we've been anticipating for years. And I see you're still there, and the lights are still on, so you must have made it through. But if you could tell us what the major impacts you see are politically, economically, and that people need to be aware of, we'll really appreciate that. Also, a recent article that you penned about the impact of central banks buying up assets and how that action is tying the fate of fiat currencies to asset markets, and why that might spell the end sooner than later that we've been anticipating, as well as how it's affecting gold and cryptocurrencies. So could you kick us off with survival of the civilized world beyond the Brexit?
Post-Brexit. Yes, there were two real considerations in Brexit. The first was political, and the second was trade. The most important was political because we have regained our independence, as it were, having lost it for about 40 years, and having given independence to all our colonies over previous decades. It's a bit of a novel experience to get our independence back. But the important thing is that if we screw it up, we can't blame Brussels. So democracy is back with us, and that is I think, the most important point. As far as trade is concerned, I think that we can move more towards being, if you like, important in the sense of encouraging free trade around the world. Certainly, this government does understand the benefits of free trade. Of that, there is no doubt. They understand the benefits of free markets. So we've got the right sort of politicians, if there's ever such a thing as the right sort of politician, in charge of our economy and economic strategy, if you like. Before this happened, there was a lot of disinformation, if you like, from companies trying to persuade the government not to do this, not to do that. And that was really the source of all this, kerfuffle. Anyway, we're beyond that now. The negotiations really start in earnest in March, and the EU is already, sort of putting out stories that they're going to want this, going to want that, and all the rest of it. So we've got ridiculous things like the Greeks want the Elgin marbles back. The Spanish want Gibraltar. I mean, this is just complete lunacy. I really do think that the negotiations are not going to go anywhere for some considerable time. There may be a last-minute realization that they have got to have a free trade type of agreement with the UK because it would damage their industry if we didn't do it. But absent that, I think we walk away at the end of this year on WTO terms. And I would actually very much like to see no payment to the EU as a result. I mean, any payment should be, if you like, dependent on them agreeing to our terms. And that's actually the key thing, because in the past, with a weak government under Mrs. May, we've always been trying to agree to their terms. This time, it's not going to happen. Our terms or nothing. It's actually as simple as that. So anyway, we can I think sort of watch that story evolve. It's not going to do the EU any good. I think both politically, because I think that the EU is fractious. Think also in terms of who is going to fulfill our role in providing money into the system. We were contributing a net 10 or 11 billion pounds a year into the Brussels pot. That's no longer going to happen. Germany's not going to want to stump it up. And I can see that is going to be a big, big problem for the remaining members of the EU. And of course, when you get countries like Greece who depend on handouts from the centre, they're going to get rationed. They're not going to like it. So I think that we leave a party with everyone just about to start having a slanging match at each other, which is not good. And it's not good in the total monetary sense, which, of course, is under the ECB's stewardship has become a complete mess, negative interest rates. They have been financing government spending, and they're now encouraging even more government spending. And they've now got a lawyer turned politician, Christine Lagarde, at the head, who even wants to spend money, printed out of thin air, of course, on environmental projects. So, I mean, we're getting to maximum inflationism in the EU. We've also got it everywhere else because the Bank of International Settlements, realizing that there's not a lot that central banks can do, they can't lower interest rates anymore, or that doesn't work, nothing works, the system is falling over, government's just got to spend to try and keep the show on the road. And that is almost official from the Bank of International Settlements. So this leads us on to the second point that you mentioned. I wrote an article about this, I think it was last week, published last Thursday, about monetary policy. The objective of monetary policy is increasingly to try and keep asset prices, financial asset prices, up, high. Inflate asset prices. This has been something that central banks have been doing for some time, but it's now got to the ridiculous point where they're almost overtly printing money, in your case through the repo market, to achieve this end. And of course, the biggest assets, the biggest asset class, which we're looking at, is not equities, but government bonds. They're wildly overvalued. If you look at in terms of what government bonds should yield, after allowing for if you like, a realistic rate of price inflation, which is not the gold sort 2%. It's closer to 10%, not just in the United States, but also everywhere else. I mean, these bonds, if you look at US Treasury bonds, they should be priced on a level which reflects that rate of inflation. So, but the 10-year bond on a 10% yield is suddenly priced not at par, but at 47% of par. So there is a huge, huge crash to come when people actually realize that government bonds are wildly overvalued. And in the case of the United States, there is a further problem, and that is that dollars are owned by foreigners and also hedge funds, because the hedge funds have been playing the swap market They've been through the swap market effectively. The banks have provided facilities for them to short euros, short yen, and go long of dollars and US T-bills and short-term treasuries. And this has become a very, very big game. It has supported the dollar ever since President Trump came in. And I think when he started talking about tax cuts, which was about April 2018, you could see that the hedge funds took the view that foreigners were going to buy the dollar, because that's where, with Trump's economic policies, it was going to increase the supply of treasuries. It would raise interest rates because it would stimulate the economy. Foreigners would buy it. They would have to buy it. It would stimulate the world economy. That was the thought back in 2018. Now we're at the situation where they're all up to their necks in dollars, everybody. And there's only one thing that can happen as soon as people realize that the whole market is horrendously mispriced, and that is that the dollar has got to be sold down. So what this does is it ties in the value of the principal financial asset in the market, which is government bonds, to the currencies. One falls, they both fall. And there is a precedent for this, and this is something I pointed out in the article. If you go back exactly 300 years, John Law had a scheme, which we now know as the Mississippi bubble, back in France in 1720. And basically what he did was he set up a bank which produced its own banknotes. He managed to turn that into a state bank. In other words, it became the equivalent of a modern central bank. He became controller of the currency, which meant that he was able to make his notes, his livre, the only currency in the country. And he could print those at will. This is a forerunner of actually what the central banks are doing today.
Sounds familiar.
Absolutely. Now, come February, it was late February 1720, he merged the Banque Royale, the Royal Bank, with the Mississippi Company. The share price at the time was something like 11,000, 12,000 livres a share. Most of these were in partly paid form because he was using partly paid scrip to ramp the share price. He'd been ramping the share price ahead of the merger. The king decided, King Louis XV, I think it was at the time, who was really a very young man, to take out some money at this juncture. And so he sold 100,000 shares at 9,000 livres each. Now, that was a discount on the market price. The purchasing power of John Law's livre had been declining noticeably in the last months of 1719, because in ramping up the share prices ahead of the merger, obviously people were selling their shares for new livre, and they would go out and they would spend them. So you had inflation, particularly food prices, which was becoming destabilizing in the months ahead of the crisis. When the crisis happened, by September 1720, there was still some value in the Mississippi shares. They were trading around about 2,000, 3,000 livres each, having lost about 70% of their value. But the livre was worthless. So the shares were also worthless. And they fell together. Now, what's interesting is that I think all of us have been thinking in terms of more contemporary experiences. When you see a government getting onto the inflation bandwagon and they've got no alternative but to print, and they print at an accelerating rate. We see a Venezuela. We go back a little bit. We see Germany in 1920 to 23. Basically, we think it takes a few years for this process to work through on the currency. But if we follow the John Law model, and it looks like we are, then it's a process that can happen a lot more quickly. And if it happens to the dollar, and therefore the rest of us, we could be looking at a radically different world by the end of this year, with equities, bonds effectively worthless, fiat currencies effectively worthless, unless someone's got the sense to step in and stop the slide. But that is difficult, because if you look at America, who in the Fed actually understands sound money? No one. Who in the government understands sound money? Certainly no one in control. Who in the ECB understands sound money? A few Germans who have got absolutely no power in the ECB whatsoever. All they can do is they can sit in the Bundesbank and complain from the sidelines. Who in Japan understands sound money? They're all Keynesians up to then. If you like, latter-day John Law followers up to in spades. I mean, this is a situation which I think is likely to be radically different from what we have all been assuming. Those of us who understand sound money and understand the dangers of the inflation of fiat currencies, I don't think we realize how short the time is now. And interestingly, in the last week or so, we have seen the price of gold begin to reflect perhaps the future, the almost immediate printing of money that we're likely to see. And of course, the timing is being brought forward by the coronavirus in China, which has basically shut down the Chinese economy. The largest manufacturer in the world, the single largest supplier of components in supply chains, shut down for business. And the coronavirus is going to spread. I mean, that's, the informed opinion appears to be it's not going to just stay in China. So what do the central banks do? I mean, they're just going to throw yet more money at the problem because it's the only thing they know. So we're going to collapse our currencies really quite quickly. There is a way out of it, and that is for someone in authority to have the mandate and the authority to bring in gold as a sheet anchor for their currencies. I'm not going to discuss how it can be done. I mean, that's a completely different topic. It can be done, but you have to understand why you're doing it and how to do it. Not too difficult, but so few people know how to do it in authority. And that, to me, is the great, great sadness in it.
We've got a question from a viewer that's closely tied with what you've been talking about. And you started off this by saying you're observing the central banks around the world are on a drunken sailor buying spree. That's my wording, of buying bonds. H. Paul Fuchs asks, Paul, he says, why is the Fed creating tens of billions of dollars every day to push the stock market higher and probably spending even more every day under the table to try to avoid a further inversion of the Treasury yield curve? So far, that's what you've described. Mm-hmm. Rather than pushing for continuous all-time highs, wouldn't it be more prudent to stabilize the stock indices at current levels?
Well, the problem, I think, is that central banks can't necessarily stabilize stock indices. I mean, because basically, at the end of the day, the stock indices are the result of everybody buying and selling stocks and shares. So, that's actually quite difficult to stabilize. The only thing that central banks can do is to continue to puff up the bubble. And I think that's the practical answer to the question. But the questioner does actually identify the real problem, and that is that we've got this, as I was saying earlier, we have got assets, financial assets, being tied in lockstep to the value of currencies. And I think that what we're likely to see in the very short term, and I think the coronavirus will probably underline the Chinese yuan first. And that's going to be interesting in one respect, because China, at least, in my opinion, I can't prove it, but all the information I have suggests this is true, has actually got a far larger stock of gold, which they can turn into monetary gold, in other words, gold reserves to back their currency issues. But I think we're likely to see the yuan fall a long way before that is implemented. And if I was a Chinese, I would sort of look at it this way. I would say that, the current price, I don't know what it translates at without really looking, but let's say the current price of an ounce of gold is 70,000 yuan, or it would be more than that. It would be about 100 and something yuan. I would probably want to see gold down to somewhere between 200,000 and 300,000 yuan an ounce, and then I would lock it in. And one can do that, if you like, by having an announcement ahead of the event, so that the markets can adjust and in effect set the rate for you. I think that's very, very important. I've always felt that that was the way to do it. If that happened, then we've got to think about the effect on other countries. I mean, fortunately, America has decent gold reserves. It's meant to have 8,132 tons or something. Whether it has or not, we don't know. There's some doubt about that. But let's assume it has. If it has those reserves, then it can also stabilize the dollar. But the problem I have with that argument is no one in authority thinks that it's in America's interest or indeed understands the importance of sound money. They've turned their back on it since 1971. They wanted to turn their back on gold earlier. Since then, they've been able to run the world with a reserve dollar, which they could print at, on demand, as and when they like. That is a very, very hard facility to give up. It really is. So I don't know what the Americans are going to do. I really don't. But I do see the purchasing power of paper currencies disappearing up the Swanee until somebody actually has the guts to stabilize the situation. Anyway, that's a bit of a long-winded answer to the question.
But grave prognosis for the year ahead here, though. You mentioned earlier in your discussion about the necessity for intervention through the repo market. Ring That Bell 2094 asks, regarding your thesis on the, quote, whale being China and the JP Morgan being the servicer for that client, regarding the huge and continued short positions in silver, is it possible that JP Morgan escaped government sanctions up until recently because they could show that their actions conformed to a client's order?
Oh, that's a very good question. I don't honestly know the answer to that. I think it's probably a bit more complicated than that. I mean, JP Morgan is the largest bank in the United States. It is central, I think, between the relationship between the Fed and a lot of the other banks. I mean, we've seen this with the way their balance sheet has almost been used by other banks through the repo market to access liquidity. And the problem really, I think, is that it is such an important bank. I'm just sort of slightly amazed that the authorities in America have sort of almost allowed people to begin to think that the trading that's been going on in the gold market might have been spoofing, front-running, whatever, involving JP Morgan. I don't know. I mean, I think it's obviously not a straightforward relationship between the authorities and JP Morgan. But the fact of the matter is that they've got to work with JP Morgan. And JP Morgan, I think, can almost tell the Fed what to do, because they can threaten complete chaos if JP Morgan doesn't. Interesting point being raised by your questioner.
When you said JP Morgan has the ability to do things, there have been theories put out that perhaps the spike of illiquidity back in September that triggered the start of the most recent series of months of bond repo action could have been an intentional demonstration of muscle flexing by JP Morgan of, look what we can do if you don't play ball nicely with us. Any thoughts of whether that's even a realistic hypothesis?
No, I don't think that's a realistic hypothesis. I mean, the fact of the matter is that JP Morgan has reserves at the Fed, but as a G-SIB, what they have to do is they have to demonstrate 30 days liquidity on all their contractual obligations, which really means they've got to have substantial reserves held at the Fed. And that's what those reserves are there for. There have been drains on the system. The two big drains on the system are, first of all, the prime brokers have had to carry U.S. Treasury, U.S. T-bill inventory, and the level of that inventory has tended to rise as the U.S. government has tended to need greater and greater funding. The second thing is that through the swaps market, the very large hedge funds have taken enormous positions, bear positions, in euros and yen, bull positions in the dollar and US T-bills and short-dated treasuries. Now, in order to maintain those positions, they need to continue to be rolled and even increased, and particularly since the foreigners are now net sellers of US treasuries. So we see a situation, I think, which is putting big strains on the overall system. And it ends up being very much a strain on JP Morgan's reserves. There is another point, and that is on the September day when the repo market rate spiked up to 10%. That was the day in which Deutsche Bank actually sold its prime brokerage to BNP, the big French bank. So, there is an element, if you like, that could have been an element of disruption, but the fact that it has continued and continued and continued tells us there is a genuine shortage of liquidity in the system.
Help us understand that a little bit, because we keep hearing from various analysts that the world is awash in U.S. dollars. We've got Dr. Mark Skidmore and his team of researchers who said they're missing $21 trillion that were created off books, and there was all these other examples of foreign buyers of U.S. bonds that are holding so many dollars. There was the disruption in Venezuela, where suddenly the economy had to be kept moving by people pulling out all the dollars from their personal holdings and everything. So how is there a liquidity crisis if the world is awash in dollars?
Well, we have to draw a distinction between deposits which are held at a major bank, let's say. Now, those deposits are actually owned by the bank, but the bank has a liability against those deposits. Yeah. So they can't actually treat those deposits for the purpose of regulation as if it's entirely their money. There is this separation in their balance sheet between deposit money and the bank's money. And there is a gearing usually of somewhere in America, it's roughly sort of 8 to 10 times. In Europe, it's probably as much as 20 times. And that assumes that the asset valuations on the bank's own capital are actually, kosher, as it were. So I think that's the first thing to bear in mind. Now, when you look at the reserves that the bank has to have, those reserves are held at the Fed, basically at the Fed. I mean, the bank will have other assets in, which you could say are attributable to its own capital, but you cannot actually include deposits in that. You have to look at deposits as a separate thing. So you can have huge quantities of dollars awash in the market, but the banks have the problem that in order to maintain their balance sheet ratios, they have got to have the reserves at the Fed in order to do so. So if you expand the amount of deposits, then quite obviously you've also got to expand the amount of reserves you have at the Fed. And that is the problem. And this is where this repo thing comes in. The repo is a sticking plaster put over the whole thing, as it were, to try and ensure that the Fed's fund rate at 1.5 to 2%, or whatever it is at the moment, can be maintained. Because without this, the Fed funds rate should be, as we saw, it spiked up to 10%. I mean, it may not be quite that high, but if they're going to continue to suppress interest rates, they have got to provide the liquidity to the big banks to ensure that interest rate levels are kept low. So that is why you can have this situation where the banks have got no money, and yet there are dollars floating all over the place, as your questioner asked. I hope that clears it up a bit.
It certainly is beyond the grasp of the ordinary person, and we've heard so many different theories ranging on what actually triggered this initial middle of September repo crisis and why it continues even now, 5 months later. We've got a question about you mentioned the fate of fiat currencies being tied to the bond markets and asset markets. T.J. Koch asks, what do you think will happen after the U.S. loses the reserve currency status? How would things play out?
That's a very good question. I think, given what I've said earlier about the way central banks have really tied in the fate of financial assets to their own currencies, I think that understanding that the linkage between financial assets and currencies and the maintenance of values and the thought that they could both fall together basically means that we need to stop thinking in terms of reserve currencies, because they will be gone. It's as simple as that. The question then is what will replace it? The only thing that can replace it really is going back to metallic money, in other words, gold, silver, or whatever people want to use as money. It I think the point is that instead of governments choosing our money for us and insisting that we use it to the exclusion of everything else, people will begin to choose their own money. I mean, if there was any scalability in it, I'm sure that Bitcoin would be very popular. Bitcoin, I would see as a store of value in this, and I can easily see Bitcoin going to $1 million, as everybody says. It could go to $1 million. Yeah, because there's really no supply relative to the supply, which we're going to see accelerating very rapidly in the coming months, relative to the supply of fiat currencies. So there will be these alternatives. And I think at the end of the day, what is most likely to happen is that we will revert to what we've had for millennia, and that is gold and silver as money. But instead of settling transactions in physical bullion, I think we will be using the electronic equivalents. And that's really why gold money has set itself up to do things in more or less that way. And so I think, I think it's a great future for gold money, if you like, in the sense we would have to adapt how we do things quite a bit. But we're already there. And I think the sort of roughly 1.5 million customers we have, hopefully are beginning to understand that that is the value of the system, that you can pay for things around the world by having a store of value in the form of gold, which is acceptable everywhere. So that will be the eventual reserve currency. But to think in terms of a fiat currency as being reserve currency, I think we can forget it.
Related question, you just touched on the lack of elasticity in the supply of cryptocurrency, like Bitcoin, for example, specifically, making it a better candidate for something that can be trusted going forward, versus some people thinking that might restrict. David Phillips says, Bitcoin is uneconomical to mine now after the halving of the reward. China mining is closed down. Is it pointing towards the end of Bitcoin?
I don't think it is, no, because it's got the distributed ledger. It's all over the place. I'm sure there will be issues such as Mr. Phillips suggested. There will be all these issues all over the time. All the time you're going to get issues like this. But basically, I think the strength of Bitcoin is the distributed ledger and the blockchain. I think it makes it unsuitable for settling purchases, if you like. And, we're used to... My wife will go and buy a dress or something, and then when she brings it home, it's not quite right, so she takes it back. How do you do that with Bitcoin? You can't really reverse transactions. It is not the most convenient form of money. But I think it can be, and it requires people to believe this, it can be a store of value. And it can be the way in which the tech-savvy people in the world today, and an awful lot of them in America, and also in China, are very tech-savvy. They have been taught at a very early stage in all this exactly what governments are doing with fiat currencies. And I think that's going to change the behavior of how fiat currencies are accepted. Because fiat currencies depend on people believing if you like, the full faith and credit in the government, which, of course, is a load of baloney. And I think that the tech savvy element is going to mean that fiat currencies lose the credibility a lot more quickly than they would have otherwise. Now, China is interesting because, yes, the exchanges are being closed down, but you can still deal on a peer-to-peer basis, and that's basically what's happening. So I think, we watch to see whether Chinese demand for Bitcoin begins to accelerate through these peer-to-peer platforms.
Related question here from Hypothetically Correct. Thank you, sir, for your knowledge and experience. My question is, after the loss of confidence in this current fiat system, do you believe a barter system will develop, or will holders of precious metals eventually have to redeem them for more fiat currency?
Well, I'm not sure it'll be redeemed for fiat currency. We have to see what actually happens to fiat currencies. There may be one or two fiat currencies left standing, in which case you can convert gold into, say, Swiss francs or whatever it might be as you spend them, if it's accepted by the other party. In terms of barter, I think barter could become more of a feature, because this is going to impoverish an awful lot of people, and they're just not going to have. They haven't got gold and silver. It's as simple as that. they'll be pawning, if you like, signet rings and, for loaves of bread or whatever.
Yeah.
I mean, that's over dramatic. Let's not go there. But I think it is certainly possible there will be a greater element of barter, if you like, in our day-to-day transactions. But what we need to do is we need to have politicians who understand exactly how they're destroying everybody's lives by being completely irresponsible with unbacked fiat currencies. And this is why I would hope that in some jurisdictions at least, the politicians might actually begin to realize that they've got to go back to backing their currencies with something credible, and to do it in a credible way in order that the purchasing power of their currencies doesn't slide anymore.
We have a question, speaking of precious metals, from John Galt, who says, when will the silver-gold ratio revert to the mean, and why?
I think the answer to that is, if you go back to around about 1870, a lot of the European countries, and I think, I don't know when America went off the sort of, if you like, the bimetallic bit, but basically everybody started dropping silver as money or as backing for paper money in around about the early 1870s. And it was at that point that the gold-silver ratio fell from the sort of 14 to 15 down to, well over 20, 30, whatever. And it's only been recently, really, that we've seen the gold-silver ratio sort of hit 90 or so. So I think silver has been very much left behind. And I think that ratio will fall as the gold price rises, because the further the gold price rises, the more likely it is that silver will be reintroduced as a form of money, physical silver. Completely different supply characteristics and all the rest of it. It's got industrial use and so on. It is completely demonetized at this level. I think as the prospect of monetization comes back, you'll find that ratio will fall quite sharply. So if you are a speculator as opposed to someone who just wants to hold some money against the evil day, then you can speculate that the price of silver will move considerably more rapidly than the price of gold.
And even those who are wanting to just be holders of precious metals and not necessarily speculators and want to increase the size of their holdings sometimes do trade off with the ratios as they deviate from the mean and cross over the mean. So, yep. One last question. This is a question that's impossible to answer in the abstract, but it's a worthy thought discussion. SCV 5454 asks, how many silver ounces should one own for a family of 4, and how many ounces of gold? But what are the principles to think about when someone's contemplating that?
Yeah, it's actually a good question. We ought to sort of spend some thinking time on this one. I think that what you probably have to do is think in terms of what your sort of normal expenditure is like. And it's particularly on things which you need to protect. I mean, if you've got a mortgage on your home, for example, if we get a really bad slump, and coronavirus could, it's not going to make this any easier. Let's put it that way. Then, if you lose your job, how can you pay the mortgage? I would argue that looking just at that particular aspect of life, as long as you can continue to pay your mortgage, nobody's going to foreclose. The lending banks or the mortgage companies or whatever it might be in terrible difficulties, and the governments will be bailing them out. But you'll have a man in the government determining whether you can continue to have your mortgage or not. And basically what you want to do is you want to ensure that you are not a problem to that man in the government at all. Continue to pay the mortgage. So you need to be able to cover those sort of regular payments. Things like utilities as well, electricity, water in particular. You need to have a reserve for that. It's difficult to calculate because, of course, the pricing of these things, I would think in terms of gold, you probably find that prices will probably halve, maybe fall a bit more. So you need to factor that into your gold ounces, as it were, or maybe silver ounces as well.
Help us understand that. You're saying that from a conservative projecting standpoint, you shouldn't assume that the current equivalent fiat value of your precious metals will hold true in a crisis situation. You should dial it back and say, well, imagine that I can only get half of what I currently could, but then how many would I need to spend? Or did you mean the other way around?
No, I'm saying rather the reverse.
Yeah.
The experience in the past is that the purchasing power of gold, and particularly when you're getting into a depression, if you like, an economic depression or a slump, which is what we're talking about, the purchasing power of gold rises quite significantly.
Yep. Okay.
While at the same time, the purchasing power of an unbacked fiat currency goes down the Swanee. Mm-hmm. So, you need to make some sort of assessment in terms of, going back to the question, how many gold ounces or gold coins or silver coins or whatever, what you actually need going forward. You've got to think in terms of, well, you still want to have the utilities delivered. And the last thing you want to do really is, again, because most of it will be back in the hands of government. You don't want that bureaucrat knocking on the door saying, you haven't paid your bill, I'm cutting you off, sort of thing. So however you pay it, just ensure that you have got enough gold and silver to be able to do it. And as part of that calculation, you can assume that the purchasing power of the gold and silver that you hoard will rise through such a crisis.
Well, Alasdair, we've got more questions than we have time left. I know we had some technical difficulties that caused us to have to restart several times this morning. So grateful that we were able to finally get a good conversation with you. Sounds like you're looking forward with some significant concern to the fate of fiat currencies in 2020 based on the unhealthy and unwholesome coupling of them to the fates of the bond markets globally. So we'll keep a close eye on that. We'd like to have you come back as we can arrange that to give us an update on how that's progressing and if we see any shift in that direction. But very grateful for you being here with us again on Finance and Liberty and Reluctant Preppers.
Thank you for asking me.
They say the stock market crashed today.
Yeah, I heard that.
Sounds like people's retirement accounts and savings accounts are going to get bailed into the banks.
Yeah.
Looks like pension plans and Social Security are going to get suspended too.
I know.
Sure, I'm glad we decided to put our money into gold and silver instead.
Me too.
Get your gold and silver and support this channel at goldsilver.com/?AFF=RP. Reluctant Preppers provides educational awareness and commentary only. Opinions expressed do not constitute personalized financial advice. Viewers are encouraged to do their own research and seek qualified personal financial consultation before making investment decisions.